Okay, welcome everybody to Building a Budget. We have with us today Mike Sandman. He is a SCORE Boston mentor. We also have two representatives from Middlesex Savings Bank. Uh, they have been fantastic sponsors of SCORE Boston. We're very thankful to for their support. But as we get started, I'm going to talk a little bit about SCORE just to make sure that you're taking full advantage of everything that SCORE has to offer. Our goal, as you may know, is small business education. We do that in a couple different ways. One is through our website, score.org. Lots of great information there. You're going to find blogs, podcasts, templates you can download, articles to read, lots of information. The other way through is of course through webinars and workshops. Those are listed on the website as well. And also they come out weekly on our newsletter. So take a look at those as they come out because we're always adding new topics. The most important thing that SCORE does, however, is the mentoring. Our mentors are volunteers. They come to SCORE with a variety of backgrounds and experiences that they want to share with you. We work with folks that are in every stage of business, whether you're trying to decide if you should go into business, you're in that planning phase, you're in business, growing your business, or ready to leave your business. We have a mentor with skill sets that can help you. A beginning session, if you've never met with a mentor before, is going to probably run anywhere in the 45, 55-minute range. They're going to want to learn about you. They're going to want to know what your goals or challenges are, and they're going to work with you to come up with a plan so that you can be successful. It's also not unusual that after you've met with your primary mentor, that other mentors are volunteer or brought in to help assist to make sure that you're getting every skill set that you need to be successful. So the next logical question, of course, is going to be, how do I get a mentor? There are multiple ways on the SCORE website. I think the absolute easiest is to go to score.org. There's a box that says, let's us do the matching for you. Put in your zip code. That pops up a contact sheet, and we're looking for information on what your current needs are with a mentor, what your business is, so that we can suggest the right mentor in our each chapter to make sure you get the right person to assist you. So today's format, we are using Q&A. Please submit questions for our presenter into a Q&A. We'll also have time at the end for our bank representatives to take some questions too. So please go ahead and put those in at any time throughout the presentation. I am recording, and that recording will be posted and also mailed out to everyone in a follow-up. The information on where to find that posting is there on the screen. So again, I did mention at the beginning, Middlesex Savings Bank is a major sponsor for SCORE Boston, and we'd like to invite one of our representatives to say a few words. David?
Hey, thanks, Teresa, and good afternoon, everyone. I'd like to thank everyone just for taking the time to join today's webinar. And on behalf of Middlesex Savings Bank, we're delighted to be today's sponsor. For those of you that may not know, Middlesex Savings Bank is one of the largest independent banks in the whole state of Massachusetts. And by independent, I mean we're a mutual savings bank, founded in 1835 with no shareholders. This is a big advantage for us that allows us to take the long view and focus on our customers and the community while not having to answer to stockholders. Business owners like yourselves, they come to Middlesex and stay with us to help solve their challenges of cash flow, funding of growth, and also investment in people, equipment, and processes. They also want to partner with someone that works with businesses just like them, one community business to another. And our bankers take the time to understand these issues, work with you to help solve them, and hopefully be part of your team as you grow. Today's webinar on building a startup budget is an important first step for any startup business. And really, it should be a regular event for any business for that matter. In SCORE is the perfect partner to assist on this journey. As a longtime supporter of SCORE, they're one of our go-to organizations that has a long track record with helping businesses plan to succeed. So I hope you enjoy today's webinar and you walk away with some ideas and lessons that you can make your own. So with that, I'll turn it over to Michael.
Okay, thanks very much. Um, Teresa, do you want to advance the slides or do you want me to put mine up?
You go ahead and share, Mike. I think that's
Okay,
easier.
yeah. Let's just set this up.
Yeah.
Okay, so we're going to get right to work here. Let me just set up a slideshow. Oh, there we go. All right. Um, Okay, I want to get right into this directly. We're going to work ourselves through some simple definitions to make sure we're all talking about the same thing and using the same terms. And then we'll get into looking at how to build a startup budget for a business that is perhaps a little bit more complicated than the businesses that you might be interested in starting or that you're already running. It involves having some real estate, having some inventory, and if you're running an online business, for example, or you don't have a bricks and mortar presence for some reason, you actually have a much simpler task than this, than what we'll be showing you here. Um, so let's start with these terms. These are really important to understand. Revenue or sales is what customers or clients pay you, and the net revenue or sales is what's left after returns and allowances. And that might seem pretty obvious, but sometimes I hear people say, well, our sales with this, and they really mean their profit at the end of the day, after all expenses. And that's not what sales are. Sales are at the top of the list. That's where all of the money for your expenses comes from. And hopefully there'll be some left over to provide you with a profit. Expenses or costs are what you pay to run the business. There are startup costs, and we're going to be talking about startup costs and how to estimate them and how to think about them. Fixed expenses, the things that go on no matter what. If you're paying rent, if you have web hosting, if you have insurance, those expenses continue whether you have revenue coming in or not. And it doesn't really matter how much revenue is coming in any particular time. They are fixed, they're stable, and you know you have to pay them. And there are variable expenses, labor, including your labor. And it's really important to include the cost or the value of your labor when you're working out your expenses. Parts, supplies, inventory, they're called variable because they go up and down depending on the amount of business that you're doing, and therefore they go up and down depending on revenue. And profit is what's left over after all of the expenses are paid. So we'll stick with those definitions as we go through, and you'll see how they interact, how they sort of waterfall down from revenue through expenses back down to profit. We're also going to talk a lot about cash flow because the amount of cash that you have on hand, the amount of money that you have in the bank, is certainly related to the amount of revenue, expense, and profit that you have, but it's also sometimes related to timing. When does that money actually get paid to you? When do you have to actually pay out your expenses? So we're going to look at cash flow in considerable detail towards the end of this. And at the very end, we're going to build a startup budget. We're going to walk through 3 pages of spreadsheets, and you think, oh my God, 3 pages. But I promise you that we're going to do this sort of one section at a time so that you'll be able to do this for yourselves and get some help, ask some questions, certainly from a SCORE mentor, or for that matter, go in and chat with one of the folks at Middlesex Bank, and they'll point you in the right direction. Okay, so why bother with a startup or even an ongoing budget projection? It helps you figure out whether the business is going to let you reach your personal income goals. And you remember I said it's really important to include the cost of your own labor. If you have living expenses that you want to cover with this business, you have to be able to take that money out even before there's any profit. So it is an expense. It's not something that is just left at the end. And it's really important to consider how much the value of your labor is when you're thinking about expenses. You have to figure out how much money you need to start up or to expand. It's really important to understand the financial risks and the financial rewards. How much money do I have to put into this? What's the potential for making that successful? What is the profitability that I'm likely to have at the other end? Is it worth the risk? You can identify development and startup costs and ongoing expenses and get a pretty good measure as you're going along as to how you're doing with those. And very important, you can give somebody who's funding you, family members, a nonprofit lender, or bank, the information that they require. Particularly with commercial lenders, what they're most interested in is making sure that you can pay the money back. They take the money that they lend you, they bring it back in as you pay it back over time, and they have it available to lend to the next customer. That's their job. And they want to make sure that you're capable, that your business is going to be able to pay the money back in an orderly way. And if you borrow money from family, from a nonprofit lender, they're going to, or they should be, asking some of the same questions. And it provides you with a plan to help guide your decisions and monitor results as you go through the year. So lots of things that give you some help when you put this budget projection together. Let's get into doing that. So some common concerns that people have when they go through this, the spreadsheets look complicated, and we're going to send you the spreadsheets that I'm using here today as a template, and you can work on them on your own. If you don't understand all the figures or the math, you can get some help with by talking to a score mentor. We have literally 10,000 people nationwide, and probably, Teresa, what do we have? About 300 people in Massachusetts and around who can help with these sorts of things. So we're going to use a tree nursery as an example. I'm going to call it Ann's Nursery. She produces specimen trees, shrubs, and vines. She's aiming to get to $710,000 at the end of 3 years. And her customers are florists, primarily, florists and landscape companies, and consumers, two very different sets of customers, if you think about it, commercial customers and consumers. And we're going to use this budget projection template that you're going to see in one piece at a time here, and you'll get the whole thing after the workshop. And the workshop worksheets are startup funds, salaries and wages, fixed and operating expenses, projected sales forecasts. We have a couple of spreadsheets for that, and a cash flow. And this will work, the spreadsheet will work for you in Google Sheets, in Numbers, in Excel, whatever application you're using. Okay, let's talk about startup funds, in this case for a plant nursery. And whatever you're doing, whatever business you're starting up, you have startup expenses. If you're setting up just a website and perhaps getting some inventory, or maybe not, maybe just setting up a website and taking orders as they come and then getting somebody else to fulfill them for you, you'll have some initial expenses. You have to incorporate. You typically will need some business insurance. So whether it's a mildly complex business like this or a really simpler one, there will be startup expenses. So thinking about her business, Ann says, well, let's see. I'm going to acquire some land because I want to be able to buy that land in order to grow the specimen trees for my tree nursery. I'm going to need a building on that land, and perhaps I can find something, don't need anything very elaborate, find something already built. It doesn't need to be close into the city. It can certainly be out in the countryside, so costs will be lower. I'm going to have to do some things to that building, probably to improve it a bit. I'll need some equipment, some furniture and fixtures, desks in the office, computer. I'll need a delivery vehicle. I'm going to need a total of $172,000 worth of assets that are so-called fixed assets. That is, they are things that will last me. Once I buy the land, once I have the vehicle, once I have the desk, those things, I'll be able to use those things on a continuing basis. So I only have to do that once, which is, of course, why it's a startup expense and it's not an ongoing expense. And then I'm going to need some cash that I'm going to have to invest in the business in order to get this all going. So I may need some pre-opening salaries and wages, depending on the kind of business that you have. You may have to do some employee training and hire somebody in advance and pay them. I'm going to have some insurance premiums that I may have to pay in advance. Got to get inventory in place because as soon as I take an order, I want to be able to ship it. I'll have some legal and accounting fees and so forth. And I'm going to have altogether about $41,800 worth of operating capital needs. That's cash I need to start the business even after I've purchased those fixed assets. So altogether, I need $213,800. And okay, that's a very specific number. It may be a tiny bit more, a tiny bit less, but that's a pretty good estimate of what she's going to need. So, how much do you need? Where will it come from? Is a really important question. We're going to talk about that in a minute. And be sure to include the inventory and labor costs that you need at the beginning, the things that you have to pay for that operating capital before you make that first sale. Okay. Some sort of a general a bit of accounting when it comes to those fixed assets. The fixed assets sit on your accounting books on your balance sheet. It's one of the three key statements that that your accountant will give you is a balance sheet showing you what you own and what you owe, what your assets are, what your liabilities are. Those assets will sit there initially at the cost that you paid for them. But you can depreciate that is write off some of the value of those assets year by year, depending on the kind of asset that you have. The Internal Revenue Service sets a schedule of how quickly you can write them off. That is, you can deduct as an expense a portion of what those assets cost you. And you think, well, why would I want to do that? Well, it reduces your profit, which, assuming you're making a profit, reduces your tax liability. And it doesn't cost you any cash. That cash went out the door. That $172,000 went out when you got into business. And so as you're depreciating that asset, you actually still have on your books the cash that you're writing off in later years. If that sounds a little complicated, don't worry about it. Chat with a bookkeeper, chat with an accountant. They can show you how it works. But it's actually advantageous to you to depreciate those assets over time in accordance with the IRS's rules. The operating capital, we've got it here. The pre-opening salaries and wages, she doesn't happen to have any of that. The other expenses and so forth that will add up to the rest of that $210,000. But again, we're going to have Ann's labor, and we haven't actually put Ann's labor in here, which we should have, but Ann is going to put some labor into this. Okay, some operating expenses, some of which are fixed and some are variable. Advertising, she figures that she's going to charge or have to pay $900 a month for advertising, whether it's advertising on her on Google or excuse me, any kind of print advertising, any sort of advertising she's going to be doing. She'll have car and truck expenses. She has insurance other than health insurance. She has a little bit of legal and professional services on an ongoing basis. That's going to be mostly bookkeeping. She'll have some office expenses, supplies and so forth for the office. She is going to have some rental or lease expenses on vehicles, machinery, equipment, a few other things. That all adds up to $4,300 a month of operating expenses that she's going to have to cover from the revenue that she brings in. So in addition to the labor costs and whatever costs she has for inventory and so forth, she's going to have to cover those $4,300 of ongoing expenses And we'll see how that all fits in. But again, it's a matter of sitting down and thinking to yourself, what am I going to have to pay every month as the business goes along? If you're uh, depending on the kind of business that you have, this will vary, but a lot of these are pretty common. Certainly advertising, insurance, legal expenses, office expenses, and so forth. Those are utilities. Those are very common expenses for just about any business. Okay, so now let's think about sales. How much money is going to come in? Anne has three categories of sales. She's going to be selling directly to local retailers. She's going to have some representatives who will help her sell to more distant retailers, and she's going to sell over the internet to end consumers, to consumers who buy from her website. And in fact, there are some very successful online plant businesses that sell on the internet. I don't know whether any of you are familiar with White Flower Farm, for example, but it's been a direct sales to consumers business for years and years, and they sell through a website and they ship their plants. So that's a piece of her business that she knows she can do, but she's probably going to recognize that the beginning sales, that when she first gets started, are going to be direct to local retailers. It takes time to get that first sale and more time to build sales volume, and you have to be realistic. So she has these three categories of sales. The first category will be direct to local retailers because she can call on those people directly. It's going to take a while before she attracts people to her website to sell to end consumers. And it's going to take a while for her to line up representatives and for them to then go and find business from the more distant retailers. So how do you do that anyway? How do you get this schedule into your head? Well, ask people who work in the same sort of business. You'll find that people, literally, if you just walk into a business that's similar to what you're doing, particularly if you're not going to compete with them directly just down the street from them, talk to them about how they started up. What did it take? How long did it go before uh, before they developed a steady stream of revenue coming in? And you want to build a month by month sales projection, recognizing that it does take time to get that first sale and more time to build it up. And again, we're going to do that as we go through this projection. Okay, let's think about sales units. What unit categories make sense for your business? Are you selling products? In which case you may want to say, well, it's by product. A tree costs this much, or I sell 10 of these or a dozen of these in a package. Services, are you selling those services by the hour? That is, do you charge by the hour, or do you give an estimate and say, well, okay, this is the fixed price that I believe it will cost, and this is what I'm going to charge you, or some combination of both. So how are you going to package what it is that you're selling? Um, Determine what makes up that unit of sales and what the cost is, or the cost of goods sold for one unit. And then determine your price per unit. How much do you have to charge in order to cover all of your costs and still give you some profit? And by the way, is that a sensible number? Can you actually see that customers are likely to buy at those prices? If you have a business in which you're selling services, your cost of goods sold is basically your labor or the labor of the other people doing the services, plus whatever parts or supplies and so forth they need in order to do the work. So I did management consulting work. Travel was a direct cost in our business in addition to the cost of labor. Okay, so let's look at a projected sales forecast for Anne and see what this looks like and where her costs are. So if she sells a pallet of mixed plants to a florist, and she's hoping to sell 125 pallets, and each pallet is $2,000. That's $250,000 worth of sales. her cost of goods sold, her costs for getting those plants to the customer, for the material cost and the cost of shipping and so forth and packaging is 137,500, 55%, we'll say. Um, and so she has a margin of $112,500 to cover all of her other expenses. Okay, the expenses that are not part of the cost of goods sold. So that 45% isn't Ann's profit. The operating expenses still have to be deducted from it. And so it's important to get these terms kind of straight in your head so that you recognize that after you deduct the cost of goods sold category from the product or service that you're selling, there's still some expenses to cover from what's left over. Okay, now there's a lot of numbers here, and let's work through this one step at a time. So up in the upper left, we've got the three product lines. Remember, I said we had plant mix, which in the units are a pallet with a whole lot of plants on them. She's going to sell a different mix, bag of plants or a small box perhaps, much smaller, much fewer plants, and she's going to sell that for $100 to consumers. And she has a plant mix bags typically that are going to go to distant nurseries, and they're bigger. Okay, so three different categories, three different prices, and the cost of goods sold is up here for each one of them. She knows that she's going to spend $1,100 of that $2,000 for a pallet of plants on growing and providing the product. She knows that she's going to spend $60 for the plants that she's selling on the web, and she knows she's going to spend $600 for the plants that she's selling out to distant nurseries. Great. Okay, so she knows where her margin is, and from that margin, all of her operating expenses have to be deducted in order to determine what her profit's going to be. Now, the interesting thing about this is, you remember I said you have to be realistic about how many you're going to sell. So when you first start in business, it takes a while to get notice. There may be a seasonal factor, particularly in the plant nursery business. So she's programmed this into her projection. So she's figuring that in January, she's only going to sell 5 bags of plant mix. And since each of them is $2,000, the cost of goods sold is going to be $5,500. That leaves her with a margin of $4,500, and that's added up right here. And we're going to go and later on take the expenses out of this, so you'll see what her ending profitability is. But the important thing here is she's only got 5 of these. She's hoping to sell 125 in the course of a year. 5's a long way from 125, and she's not selling any of these other products. And February, March, similarly, 5 bags of plant mix, or 5 pallets of plant mix in this case. And she begins to build up in April, May, June, July. April 10, May 20, June 20, in July. She figures everybody goes on vacation, or they don't do a lot of planting in July because it's hot. The best times to do planting are in the spring and the fall. In August, things begin to come back, and then things tail off towards the winter time. And that adds up to in her projection, in her thinking about what the curve is, what the rate at which she's going to sell, that comes up to 125 of these at the end of the year, $250,000 at $2,000 a piece, and that gives her the $112,500 of margin from which to take her expenses. She's also expecting to begin selling plant mix to consumers on the web. And there again, she'll start small, and she hopes to build up for the fall. And she's hoping that for Christmas, people will be buying some things from her as well, to decorative plants, wreaths, and so forth that she can sell. And so her sales curve here starts off at $5,000 in May. There's nothing for the first 4 months. And and she gets up to $10,000 and then $20,000, and then it drops off rapidly. And presumably, in the next year, it begins with some real numbers in January, February, March. But again, it will take off fairly slowly because of the seasonality of her business. And you can see the cost of goods sold and the margin calculated here. It's going to take some time to get distributors and begin to sell to distant nurseries. And so she's figuring that's not really going to start until September. And she's hoping that that will build up in October to a substantial amount. And so she's got that in here. But again, the price is $1,000 per unit, not $2,000. So you can see again, we've calculated out the totals. When you put it all together, the sales is only $10,000 in the first month, and it builds up slowly to take off to $45,000, she hopes, in May. And you can see the totals here as they go along. And she's hoping to have, in the first year, $347,000 worth of sales. And she's expecting that her cost of goods sold will be close to $200,000, $195,700, and excuse me, to have $150,000 worth of margin left for her other expenses. So take a good look at this one last time. You can see that curve, that slow buildup of sales. Every business that starts up has a curve like that. Some may start up more quickly, some may take much longer. And depending on the sales category and who you're selling to and how much work you have to do to make that sale, you have to figure out how long it will be before you begin to get those sales in. Okay, so again, thinking about, well, where do I get this information? Unit cost and price, build that up from suppliers. You can learn from competitors. You can talk to people who are in the same business. You can walk into a store and see what people are charging. You can go online. You can even place some orders and see how they fulfill those orders and what the shipping costs are likely to be. You have to think about how much volume you're going to have in units. One of the best ways to learn about all this stuff is to work in the industry. So if you have worked in a company that does something similar to what you're planning to do, you have a huge leg up. And honestly, when people come in and talk to us about starting a business, one of the first things we ask them is, have you worked in this business or in something related to it? Because that's the place where you get a lot of the answers to the questions that you have to answer in order to do this with some accuracy. You can do some estimates from news reports, you can observe your competitors, join a trade association. Almost every business category in the world has a trade association that you can join and get information from the trade association about what are the common practices in this business. Can I batch together with other companies to get group insurance policies and so forth? A trade association can be really, really useful. And then estimate the sales volume that you need to make the business profitable. And if there's a mismatch between what you think is a reasonable level of volume and what you need to make the business profitable, don't do that. Hopefully there will be a good match. You can get some help on some of this from the business section, the Kirstein Business Library at the Boston Public Library. If you go in there, the business section is downstairs in the new building of the Boston Public Library that is located on Boylston Street in Back Bay. Go downstairs, talk to the research librarians there and the reference librarians there, and they will help you out. They'll get you information about, well, where are the trade associations and which ones have what sort of information and what kinds of things are published about this business, and has anybody written a book about it? So there are all sorts of things. There's an online journal. There typically are online journals for just like there are trade associations for just about every category of business. So there are sources of information And if you come to SCORE and you are looking for a mentor in a particular kind of business, the chances are pretty good that we have somebody who's experienced in that business, and you can connect up with somebody who's perhaps spent a career in it. Okay, some other things to think about, and we're not going to overcomplicate Ann's spreadsheet with this, but I do want to mention that when we talk about cash flow, it's important to recognize when you get paid and when you have to pay your bills. So Ann is thinking about, well, I'm going to get paid. I'm going to give a line of credit to the commercial customers that I have, the florists and so forth, the landscapers. I'm going to assume that some of them are going to pay me within 30 days, and some of them are going to pay within 60 days, and some are going to take longer than that. And hopefully, they're all going to pay me. So I won't have any allowance for bad debt. But there's a period in which I'm going to have to fund basically what I've already sent to them. The cost of doing that without getting their money in, and in her thinking, that's the sort of the schedule. 30% in 30 days and so forth. Now, for online sales to consumers, she's going to get it all. They're typically going to pay by credit card, and she doesn't have to give anybody credit. She has to pay a credit card fee, but she's going to get that money essentially the same day that the charge is made, credited to her account. Accounts payable, how fast does she have to pay her suppliers? Some of her suppliers may give her credit and let her pay between 30 and 60 days. Some of them may not. If she knows that, or she talks to people who are in the business or talks to suppliers, she'll get a sense of what the credit terms typically are in that sort of business. Some suppliers will say, well, you're brand new and you really, I can't give you any credit. You have to pay me when I deliver. Some of them will say our standard terms are 30 days or 60 days, and they'll let you run a line of credit, but you do have to pay within that line, otherwise you won't get the next shipment. Okay, so that's something to think about. It's going to vary by the type of business that you have and by who the customers are and who the suppliers are. Remember that it can be a factor in the way cash comes into your business and the way you have to pay it out. Okay, now we've talked a lot about expenses. Let's talk about where the money comes from to get this whole thing started. So Ann is going to start with she needs $213,800, as we said at the beginning, in order to get going. She has a home equity line that she's going to take out and put $115,000 from that into the business. She's going to be able to get a commercial loan because she's putting some money in on her own, substantial amount of money in on her own, and so she has proven that she has a big stake in the business. She has a building; she'll get a commercial mortgage on that. She has vehicle loans, and she's altogether she identifies those three sources of additional funding, and that's what gives her that $213,800. She can't go into business until she gets that lined up. Or at least she certainly shouldn't begin to spend a lot of money until she gets that lined up. She has to know where those things are coming from, where those expenses are coming from, and there's a cost to them. There's a loan rate, and so looking at how many months that loan will run, there's a payment at the end of each month that becomes a fixed monthly expense. And if she has that all lined up, that's great, but she has to make provision for that in her expense lines, that $1,300 and some change of loan expenses. For existing businesses, think about the cash that you already have on hand from accounts, the cash that you have, the accounts receivable, the money that you're expecting to come in, any expenses that you prepaid and so forth. Those are things that you have to add up. So it's a bucket of cash plus receivables that will be turned into cash minus the payables that will be paid out in the near term, that's the pile of cash that you have to expand your business, for example. But at the beginning, you need to identify where you're going to get the money to start up. And Anne has done a pretty good job of thinking about this. And she has an equity line that she can use in order to really get the bulk of it off the ground. Okay. The next step is this big cash flow that I said to you we're going to walk through on 3 pages. So we're going to combine the revenue projections that we have. And you remember those revenue projections, she starts small and builds up for each one of the categories. And then we're going to look at her expenses, and some of them are going to be fixed, and some of them will vary with the amount of a product that she's producing or selling. So cash on hand at the beginning of the month. Now, that $41,800, where does that come from? That comes from way back at the beginning. In fact, let's go all the way back very quickly to that. Right down here at the bottom, you remember we said, in addition to the money that we are going to pay out and not have in our hand anymore, we're going to pay out for the real estate, for the buildings and so forth. We need $41,800 worth of operating capital, some cash, basically cash in the bank. So that $41,800 comes right back at the beginning of the calculation as one of her startup expenses, one category of startup expenses. So she has $10,000 worth of cash receipts because she sells those initial 5 pallets at $2,000 a piece, and that money comes in and adds up to her bank account. She has $51,800, and now she has to start taking money out for her expenses. And so labor comes up to $13,507. The staff person that she has, $25 an hour. She has an owner manager, that's her labor. She's paying herself that. And she has taxes and employee insurance. And so she has payroll and taxes of $13,507. And for the sake of simplicity, I've left this constant through the year, but obviously it's going to go up when she has to hire more people, and she really needs to project that into here. And then she's got her operating expenses, and those are pretty much stable through the year. Her advertising is $900 a month, as she expected. These are right off of that projection that we made at the beginning about what her operating expenses are going to be. She's got $4,300 worth of operating expenses, and that is constant through the year. So again, we have $13,000 worth of payroll and payroll taxes, $4,000 worth of operating expenses, and $704 of other expenses, including repaying those loans. She's got $18,511 worth of expenses in that first month. But you remember she only had $10,000 worth of revenue come in. So she started off with $41,800 worth of cash. She added $10,000 worth of revenue. She subtracts $18,511 of all expenses, and she has less cash at the end of the month than she started with. She has $33,290 at the end. And that's because when you start the business, you're typically going to have those fixed expenses from the beginning, and it's going to be a while before you build up your revenue. And that's very typical for almost every business that you can think of. So let's go back and take a look at how things go through the year so we get a sense of what happens to her cash flow. So she builds up, her cash is $33,200 in February. That's the ending amount from January. And in the next month, she has only $10,000 worth of revenue. $10,000 again. And so her cash is going to gradually decline because she's got those fixed expenses on a monthly basis that she has to pay no matter what. In April, she's come all the way down to about $16,000 of cash on hand. She started with 41,800. So what's going on here? Well, her sales are beginning to build up. And so she gets in $20,000 in that fourth month. And you can see that her payroll and taxes are the same. And uh, her expenses are the same in April. And so she begins to build up a couple of $1,000 of her $1,000 and some change of cash between March and April, begins to come back up. And that goes on month by month, so that by the end of the year, she expects to have $160,000 worth of cash at the end. And uh, the question that she has to ask herself, is that realistic? Have I got the right amount of labor in here? I probably am going to have to hire some people. Probably ought to go back and change that labor number. So the cash flow projection will give her a sense of how close she's going to come to not having enough cash, and to sort of test out that cash on hand need that she identified. And then how is the business going to operate as she goes along through the year, and what is she going to end up with for cash after the revenue that she expects by the end of the year. She has to get to the end of the year, which is why she goes through this uh, process of figuring out all of these expenses and figuring out how her cash is going to look each month. If she didn't do that, if she just started off with less than, well, basically, if she started off with less than about $25,000 in cash, she'd run out of cash by the end of April. And that would be the end of her business. She'd be in trouble. She wouldn't be able to pay her expenses. So it's really important to figure out your initial expenses and make sure that you're going to have enough cash on hand to be able to get yourself all the way through that startup period. Okay, so why do we bother with a startup or an ongoing budget projection like this? We have to figure out whether the business is going to enable you to reach your personal income goals. She's going to be taking out $700 to $800 a month for herself. Can the business support that? And by the way, is that enough for her, at least to begin with? And she'll have some profit at the end of the year, and she can take some money out of that. But in the meantime, can she live on that $700 to $800 month by month? Figure out how much money you need to start or expand, and we've done that. You give a funder, in this case, the lenders that she's been able to go to, give them the information that they require. And for that matter, she's putting $115,000 of her own money into this. Is she comfortable with these numbers? Is she comfortable doing that? It'll give her an understanding of the risks to that $115,000 and the rewards, and identify any development, startup costs, ongoing expenses, so that she can put all this stuff together and come up with answers that are going to be realistic. And it provides a plan for her month by month. She can look in April, she can look in October, and so forth, and see how she's doing. Okay, we've gone all the way through the process of working through that spreadsheet. I'm sure there are some questions. Teresa, what have we got in the Q&A?
Actually, I don't have a lot in Q&A, but please get those questions in. I did have a question earlier, and we'll start with that as we get more questions put in. Is the setting up your budget similar to for a nonprofit?
Interesting question. So yes, a nonprofit still needs to have enough cash to operate from the beginning of the year to the end of the year. And you typically, a nonprofit will want to show some surplus at the end of the year. They don't, it's not called a profit, it's because you're You are a nonprofit, you're exempt from taxes, but you nonetheless have to have some money in the bank at the end of the year in order to operate for the next year. Um, there's really not much difference except in some terminology that you use. And of course, a nonprofit is typically drawing some funding from the public, uh, donations or something, or grants or something of that sort. So those are perhaps different sources of income than a commercial or for-profit business would have. But the process is very similar. Still have to have enough money to get started, and you have to have enough money to operate through the year.
Okay, I guess I have a bank question. How important is a budget in a business plan when coming to the bank for funding?
Well, we have a couple of folks from the bank to
Yeah, if we can get the
so
banks to,
I don't want to throw the question at them without first giving them a chance to think about that. But that's a key. The bank, if there's anything at all that the bank wants to see, it's that cash flow projection. Uh, they want to make sure that you can pay back the money so that they can continue to stay in their business, which is to lend money to the next customer who comes along. So Dave or Jeff, if you want to make a comment, you're welcome to do that.
Jeff, you can go
Yeah.
first. Yeah.
Sure. No, I was going to say I echo Mike's comments. Having a budget that the business owner is prepared is crucial. It gives them a sense to show us that they understand the business, they understand the revenues and expenses that Michael was describing, and we can assess whether it's realistic, either comparison to your past performance of your existing business, or potentially other clients in the same area. If the margins are appropriate, if the returns are appropriate, if the expenses are appropriate. So it's a really good way to display your knowledge of the industry as well as your expected performance of the business.
Yeah, and I guess I'd add to that, Michael, that typically we like to see 2 years of income statement, balance sheet, and cash flow projections. Not the topic for this webinar, but we'd also like to see a business plan associated with that individual can articulate themselves and not have a third party talk about it. And what do they bring to the table? What's their market look like? Why do they think they're going to be successful?
So Anne might want to put in her experience in the business in the business plan, and uh, what her plans are for what her expectations are for getting up to that $700,000 of sales in the future that she's hoping for.
Sure.
Excuse me. Um, that's what but the core of really of that business plan is a financial projection. Other
Absolutely.
questions?
okay, Mike, this is a two-parter. What happens when it comes to time to paying yourself and you have to use the tax money that you had put aside?
Oh, well, so the I'm not sure.
They saying they don't have it. They're using the money that that they would set aside to pay their taxes. Instead, they're using it to pay themselves.
Oh, that's a very dangerous thing to do. Your taxes need to be paid as you go. Your employment taxes in particular need to be paid as you go, and you really can't get. Yeah, so let me step back. With payroll, whether you're paying yourself or you're paying employees, it's very sensible to go to, certainly if you have employees, go to one of the payroll services that will issue the check for you. They'll reach into your bank account and issue the check, and they will also withhold the funds that are due for federal, state, and local taxes if there are any local taxes. But this question is also about quarterly taxes. So your quarterly taxes are based on how much profit you expect to have, or how much income you as an individual expect to have. Uh, you have to talk to a bookkeeper or an accountant about how to do that. Uh, and you need to take some of the cash that is at that bottom line and have it available in order to make those payments. So you may very well have a line in there for tax payments in your projection.
Okay. Actually, you hit the second part of the question already, so we can go right on to the next one.
Yeah.
How many months of operating expenses do you need to include in a startup budget?
So I would say you certainly you absolutely have to have a year. Okay. So go all the way out through 12 months until you have a stable situation, if you feel like that's right. And as I think Jeff said, it's typically, or David said, the bank will want to see typically a couple of years projection. It's a very useful exercise because you get a sense of, well, okay, in that first year, I had those startup costs and so forth, and I had that lag before my sales got going. What does my second year look like? Is that you may, in fact, show a very, very thin profit um, in that first year, but in the second year, hopefully, you'll show a better profit because you haven't got those startup factors.
Okay. I have a Dave and Jeff question. I'm going to smush two questions together. Do banks loan to businesses that haven't started yet? Do they all require 1 to 2 years of business establishment? And how do you, if you aren't already in business, how is there other ways to establish that you're capable of repaying the funds so that you can get a loan as a startup business?
Sure. So I'll let the bank that
Yes,
each bank
please.
has its own approach, and honestly, local banks like Middlesex will take a much more, um, shall I put it, they'll be more flexible than one of the larger banks when it comes to deciding when it comes to a criteria this time, whether somebody needs to be in business for a year, 2 years, or they'll fund a startup. There are some nonprofit lenders who will loan to a startup. Um, and for example, they're that I'm familiar with is the Dorchester Bay Development Corporation. They have a fund for making loans to startups. Other local business development corporations, there are several of them in the metropolitan area of any city, will help with that, or could help with that. But when it comes to a bank, banks vary in how much time they expect to have you in business have before they'll consider a loan. Dave or Jeff?
Oh, I could jump in here, Jeff, if you
Sure,
want.
go
I think,
ahead.
we try not to discourage anybody from applying for a loan, no matter how long you've been in business. And really, it depends on what the story is to be told. That's why we want to understand your projections. We want to understand the assumptions behind them, your experience, all those factors. And that's true whether you're a startup or been in business for quite some time. And was there a second part to that? I guess
Uh,
No,
that's
I
how
think
we
that's
that's
how
how
you
we
can,
understand if you're going to be able to repay the loan. Then I guess
yeah, I
the
think
projections.
I think you hit both the question. I think you hit both of those questions. I do have another question for you, Dave and Jeff, though, please. Does a bank consider personal credit history when asking for a loan when you're applying for a loan?
Dave, I can jump in there. I was going to add that to the last question and answer. We certainly look at a guarantee, personal guarantee, and the strength of the individual, including their credit score. Certainly, if there was a startup situation, we perhaps would lean heavier on that, the strength of the guarantor or the owner of the business, which would include, their assets that they have available as well as their credit score. So that is definitely an important part of any credit decision.
Okay. Oh, and is there a list of banks that support the SBA, or support SBA loans? And absolutely, you can find the list on the SBA website for sure.
Correct.
Yeah, yeah. There are a number of banks in Massachusetts and Rhode Island that are very active supporting. An SBA loan, it's not the SBA that makes the loan; it's a bank, and the SBA provides a guarantee to the bank, which reduces their risk. So that's what SBA loans are all about. You have to go through a lot of paperwork in order to get one, and SBA wants to see some of the same things as the bank because they also want you to be able to pay it back. There's a question here about how soon do you have to start paying the loan back? Depends on the loan. Sometimes you have to start paying interest right away. Uh, but again, or in fact, I think that's probably more typical. But you negotiate the loan conditions with the bank. There's a question about how do you account for taxes when being a sole person or a limited liability corporation? Okay, so there are two different things here. If you're a sole proprietor, you're not an LLC, you're not a limited liability company. A limited liability company is just you, but you are wrapping yourself in as a separate entity from a liability perspective by incorporating as a limited liability company. All of the income from a limited liability company flows back into your personal tax return. So it doesn't really matter if you have an LLC set up or not. Everything that the LLC earns will be on your 1040 file your taxes. So basically, you're taking all of that income, both the monthly salary that you pay yourself and the profit at the end of the year. You have to pay taxes on that on your 1040. And how much do you decide to pay yourself? Well, I mean, one of the questions is how much do you need? Uh, and, if you have some other source of income, uh, so you don't need a lot, that's great. If you expect that you're going to have to take all of your income out of that business, well, the business has to start off with the cash capability of paying you.
Okay.
All
I
right.
think we hit them all.
All right, great.
So thank you very much, Mike, for sharing the information. I did have a couple questions about financing a business and getting grants. It wasn't bank oriented, so I am referring you to the upcoming financing a business webinar. I put that in chat. It's also in the Q&A. David and Jeff, thank you so much for supporting SCORE. And we will look forward to working with you again and working with all the folks on our attendance today. And I see a whole list of thank yous scrolling through chat. So I think everyone agrees. Okay. Thank you, everybody.
Bye-bye. Thank you all.